Before we dive in, a quick but important disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as and should not be construed as financial, investment, or trading advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The past performance of any trading system or methodology is not necessarily indicative of future results. All trading involves risk. Please consult with a qualified financial professional before making any investment decisions. Every single day, over $7.5 trillion changes hands in the global foreign exchange market. Let me say that again. 7.5 trillion. That's more than the New York Stock Exchange, the Nasdaq, and the Tokyo Stock Exchange combined. It is the largest, most liquid financial market on the entire planet. And yet, for most aspiring traders right here in the US, there's a secret language being spoken in this massive arena. A single word that acts as a gatekeeper. It's a word that sounds small, almost insignificant, but it's the key that unlocks everything. That word is PIP. You've probably heard it. You've seen it in articles, heard it in trading rooms, seen it pop up on your trading platform. The euro just jumped 30 pips. I'm targeting a 100 pip profit. My stop loss is set at 20 pips. And if you're like most people starting out, you nod along pretending to get it, while a voice in the back of your head is screaming, "What on earth is a pip?" Feels like everyone else is in on a secret, and you're on the outside looking in. It's the reason the charts can feel like hieroglyphics. It's the missing link between seeing the price move and actually understanding what that movement means for your money. Well, that confusion ends today. Right here, right now. The core promise of this video is simple. By the time this is over, you will not only understand what a pip is, you will understand it so deeply, so intuitively, that you'll wonder how you ever found it confusing. We are going to demystify it, break it down into simple, plain English, and give you the foundational knowledge that separates the confused beginners from the confident traders. We're going to turn that question mark in your head into a light bulb, because understanding the pip isn't just a piece of trivia. It is the fundamental unit of measurement for profit and loss in the biggest market in the world. And you can't win the game if you don't know how to keep score. So let's rip the band-aid off. What does the word pip even stand for? You'll hear a couple of different answers, but they both point to the same concept. Some say it stands for percentage and point, while others say price interest point. Honestly, you don't need to memorize either one. What you do need to remember is what it represents. A pip is the smallest standardized unit of change in a currency pair's exchange rate. Think of it like this. Here in the US, we measure our currency in dollars and cents. The smallest unit we commonly deal with is 1 cent, or $0.01, 1 cent. A cent is the smallest standardized unit of a dollar. A pip is to a currency pair what a cent is to the dollar. It's the base unit of movement. It's how traders measure how much a currency's price has changed, up or down. So where do we find it? This is where people get tripped up, but it's actually incredibly simple once you see the pattern. For the vast majority of currency pairs, we're talking about pairs like the euro versus the US dollar, euro to US dollar, the British pound versus the US dollar, pound sterling to US dollar, or the Australian dollar versus the US dollar, Australian dollar to US dollar. The pip is the fourth decimal place. Let's make this real. Imagine you look at your screen and the exchange rate for the euro to US dollar is 1.0750. You're looking at 4 numbers after the decimal point. The pip is that last one, the fourth digit. So in 1.0750, the 0 is in the pip position. Now let's say the market moves, and the price changes from 1.0750 to 1.0751. That price has moved up by 1 single pip. That's it. That's the entire concept. It's a 1-digit change in the fourth decimal place. If the price moved from 1.0750 down to 1.0740, it has moved down by 10 pips. See, you're already getting it. We're just counting the change in that fourth position. But wait, you might be thinking, I've seen some quotes with 5 decimal places. And you are absolutely right. This is where we introduce the little brother of the pip, often called a pipette or a fractional pip. That 5th decimal place represents a 1/10 of a pip. So, if the price moves from 1.07500 to 1.07501, it hasn't moved a full pip. It's moved 1/10 of a pip. It's like the difference between a dollar and a dime. The pip is the dime, the pipette is the penny. Most professional traders focus on the full pip movement, that fourth decimal place, as the primary unit of measure, but it's crucial to know that the fifth decimal exists to provide more precise pricing. Now, just when you think you've got it all figured out, there's one major exception to this rule you absolutely have to know. It involves any currency pair that includes the Japanese yen, or JPY. For pairs like the US dollar versus the Japanese yen, US dollar to Japanese yen, or the euro versus the Japanese yen, euro to Japanese yen, the rule changes. For these pairs, the pip is the second decimal place, not the fourth. So, if you see the US dollar to Japanese yen quoted at, say, 157.25, the pip is that second digit after the decimal, the 5. If the price moves from 157.25 to 157.26, that is a 1 pip move. And just like before, if you see a third decimal place like 157.255, that third digit is the pipette, or a tenth of a pip. The reason for this is simply because the value of a single yen is so much smaller than that of a dollar or a euro, so the market convention for quoting it is different. So let's recap the ironclad rules we've just learned. Rule 1. For any currency pair that does not involve the Japanese yen, the pip is the fourth decimal place. Rule 2. For any currency pair that does involve the Japanese yen, the pip is the second decimal place. That's it. If you can remember those two rules, you have conquered the most confusing part of identifying a pip. But this brings us to the most important question of all. So what? Who cares about a tiny little movement in the fourth decimal place? Why does this even matter? It matters because pips are the language of profit and loss. When you place a trade, you're not thinking, I hope the price goes from 1.0750 to 1.0850. A professional trader thinks, I am targeting a 100 pip profit on this trade. You're not setting your risk by saying, I'll get out if the price drops to 1.0730. You're thinking, I am setting a 20 pip stop loss. Pips standardize the conversation. They allow a trader in New York to talk to a trader in London and a trader in Tokyo, and they all instantly understand the scale of a price movement, regardless of the specific currency they're trading. It's the universal ruler for the Forex market. By measuring market movements in pips, you can create a consistent strategy, manage your risk effectively, and calculate your potential profits and losses in a way that makes sense across any currency pair you choose to trade. Now, knowing what a pip is the first giant leap. But it's only half the story. The next logical, critical question is, what is a pip actually worth? How does that tiny movement in the fourth decimal place translate into real dollars and cents in your US-based trading account? Because a 1 pip move in the euro to US dollar isn't worth the same as a 1 pip move in the pound sterling to Japanese yen. And the value of a pip changes dramatically based on the size of the position you take. This is where the rubber meets the road. This is where we connect the abstract concept of a pip to the concrete reality of your account balance. And understanding how to calculate a pip's value is the next essential skill you need to master. So how do we do it? How do we translate that tiny fourth decimal place movement into a number that actually means something to us, a number with a dollar sign in front of it? It's simpler than you might think, but it depends on 3 key ingredients. Think of it like a recipe. To figure out the final value, you need to know these 3 things. First, the currency pair you're trading. Second, the size of your trade. And third, the current exchange rate. Let's break down each one because this is where theory becomes practice. First up, the currency pair itself. As we touched on before, every pair has a base currency and a quote currency. In a pair like euro to US dollar, the euro is the base and the US dollar is the quote. The easiest way to remember this is that the base currency is always the one on the left, and it always has a value of 1. So when you see euro to US dollar at a price of, say, 1.0800, it means 1 euro is worth $1.08. You're always buying or selling the base currency. Now, for US traders, this is great news when the US dollar is the quote currency, the one on the right. Why? Because the math gets incredibly simple. When the USD is the quote currency in pairs like euro to US dollar, pound sterling to US dollar, or Australian dollar to US dollar, the value of a pip is calculated in US dollars directly, and you can almost lock in a set of easy-to-remember values. But to understand those values, we need to talk about the second, and arguably the most important ingredient in our recipe, your trade size. In the world of Forex, you don't just trade 1 euro or 1 pound. You trade in standardized amounts called lots. This is a concept that trips up a lot of new traders, but let's make it really simple. Think of it like ordering eggs. You don't go to the store to buy 1 egg, you buy a dozen. In Forex, you don't buy 1 unit of currency. You buy a lot. And there are three main sizes you'll hear about constantly. The biggest is the standard lot. A standard lot is 100,000 units of the base currency. So if you place a standard lot trade on euro to US dollar, you are controlling 100,000 euros. This is the big leagues. This is the institutional size. Next down is the mini lot. As the name suggests, it's smaller. A mini lot is 10,000 units of the base currency. So a mini lot trade on euro to US dollar means you're controlling 10,000 euros. This is a very common size for experienced retail traders. And finally, we have the micro lot. This is the smallest of the three, at 1,000 units of the base currency. A micro lot on euro to US dollars control over 1,000 euros. This is often where new traders start, as it allows them to get a feel for the market with a lower level of risk exposure. So why does this matter so much? Because the lot size is the great magnifier. It determines how much financial impact each pip of movement has on your account. Let's connect this back to our euro to US dollar example, where the US dollar is the quote currency. This is where you should grab a pen or just listen very closely. For a standard lot, that's 100,000 units. One pip of movement is worth $10. That's it. One pip. If you buy euro to US dollar and the price moves up from 1.0800 to 1.0801, with a standard lot, your position has increased in value by $10. If it moves down one pip, it's decreased by $10. Every single pip is a $10 event. For a mini lot, 10,000 units, the math is just as easy. One pip of movement is worth $1. Price moves up one pip, you're up $1. It moves down one pip, you're down $1. Simple as that. And for a micro lot, 1,000 units, one pip is worth 10 cents. A 1 pip move in your favor means a 10-cent gain. A 1 pip move against you, a 10-cent loss. This is a fundamental rule of thumb for US traders. For any pair where the US dollar is the quote currency, you can pretty much remember it as standard lot $10 a pip, mini lot $1 a pip, micro lot 10 cents a pip. This relationship between lot size and pip value is the engine of your trading. The size of your lot is the gas pedal. A micro lot is a gentle cruise down the street. A standard lot is flooring it on the highway. The same 1 pip distance traveled results in a vastly different change to your fuel tank, or in this case, your account balance. But what happens when the world isn't so simple? What about all those other currency pairs where the US dollar isn't the quote currency? What about a pair like US dollar to Japanese yen, the US dollar versus the Japanese yen? Or US dollar to Swiss franc, the US dollar versus the Swiss franc? Here the US dollar is the base currency. This is where our third ingredient, the current exchange rate, comes into play. The calculation has one extra, simple step, and understanding it is what separates the casual observer from a serious trader. Let's use US dollar to Japanese yen as our example. As we know, yen pairs are different. A pip is the second decimal place, not the fourth. So a 1 pip move is 0.01. Now let's say you want to trade a standard lot, which is 100,000 units of the base currency. In this case, the base currency is the US dollar, so you're controlling $100,000. To find the value of a pip, you take the pip size, 0.01, and multiply it by your lot size, 100,000. So 0.01 times 100,000 equals 1,000. But 1,000 what? Here's the key. The pip value is always determined in the quote currency. In the US dollar to Japanese yen pair, the quote currency is the Japanese yen. So 1 pip of movement on a standard lot is worth 1,000 Japanese yen. Now, for a trader in the United States, knowing a move is worth 1,000 yen isn't very helpful. You need to know what it's worth in your account's currency, in US dollars. And how do you do that? You use the third ingredient, the current exchange rate. You simply take the pip value in the foreign currency, 1,000 yen, and divide it by the current US dollar to Japanese yen exchange rate. Let's say the US dollar to Japanese yen rate is currently 150.00. You would take your 1,000 yen pip value and divide it by 150. So 1,000 divided by 150 is about 6.67. And there's your answer. On a standard lot of US dollar to Japanese yen, with the exchange rate at 150, 1 pip is worth approximately $6.67. Notice what just happened. The pip value is not a fixed $10 anymore. It's dynamic. It fluctuates. If the US dollar to Japanese yen exchange rate were to rise to 160, that same 1,000 yen pip value would now be worth about $6.25, 1,000/160. If the rate fell to 140, the pip value would increase to about $7.14, 1,000/140. This is a critical concept. For any pair where the US dollar is not the quote currency, the dollar value of a pip is not fixed. It changes along with the exchange rate of that pair. The good news is you don't have to do this math by hand every single time you place a trade. Every modern trading platform calculates this for you in real time. But you absolutely must understand the mechanics behind it. You need to know why a 1 pip move on euro to US dollar feels different from a 1 pip move on US dollar to Japanese yen in your account. It's about understanding the forces at play. It's about knowing that when you trade a cross-currency pair, one that doesn't involve the US dollar at all, like euro to pound sterling, there's an extra layer of conversion happening in the background to present that final profit or loss in US dollars. So let's recap the journey. We've established that a pip's value is determined by the currency pair, the lot size, and the current exchange rate. For US traders, when the dollar is the quote currency, life is simple. The $10, $1, and 10-cent rule for standard, mini, and micro lots is your powerful shortcut. When the dollar is the base currency or not involved at all, the pip value is calculated in the quote currency first, and then converted back to dollars using the prevailing exchange rate, making its value dynamic. Now you can look at a price chart and see more than just a squiggly line. You can see a 1 pip flicker and instantly have a general idea of its dollar significance based on your trade size. You have the formula. You understand the ingredients. But this brings up a fascinating and crucial question. If a single pip on a common mini lot is only worth about $1, how do people see significant returns from what look like small movements on a chart? How is it possible for an account to see a $50 or $100 change when the price only moved 50 pips? The answer is a mechanism that is perhaps the most powerful and the most misunderstood concept in all of Forex. It's a double-edged sword that can amplify your outcomes, for better or for worse. It's called leverage, and understanding how it connects to pips and your actual account margin is the difference between a calculated approach and a reckless gamble. So let's break down this concept of leverage with a simple real-world analogy. Imagine you need to move a massive 1-ton boulder. Trying to push it with your bare hands is impossible. You simply don't have the strength. But then someone hands you a long, sturdy steel lever and shows you how to place a small rock underneath it to act as a fulcrum. Now, by applying a small amount of force to the long end of the lever, you can lift that enormous boulder. You haven't magically become stronger. You've just used a tool to amplify your existing strength. In the world of Forex trading, leverage is that steel bar. Your trading capital, the money in your account, is the force you apply. The massive boulder is the Forex market itself, a multi-trillion-dollar-a-day behemoth. And your broker is the one who provides the lever. They allow you to control a much larger amount of currency than what you have in your account. This amplification is expressed as a ratio, and you'll see figures like 50 to 1, 100 to 1, or in some regions even higher. In the United States, regulations typically cap this at 50 to 1 for major currency pairs. Let's use a 50 to 1 ratio to make the math crystal clear. This ratio means that for every $1 you have in your account, your broker allows you to control $50 in the market. So, if you have a $2,000 trading account with 50 to 1 leverage, you can open a position worth up to $100,000. That's a standard lot. Without leverage, to control a $100,000 position, you would need, well, $100,000. Leverage is the key that unlocks the ability for retail traders to participate in a market dominated by huge institutions. But here is the critical connection back to pips. The value of a pip is determined by the size of your position, not the size of your account. Remember our euro to US dollar example, where a 1 pip move on a standard $100,000 lot is worth about $10. With leverage, you, with your $2,000 account, are now controlling that standard lot. This means every single pip that the market moves is now worth $10 to you. The market moves 10 pips in your favor? That's a potential $100 gain. That's a 5% return on your $2,000 account from a tiny price fluctuation. You can see the appeal. It's powerful, but the lever works in both directions. The market moves 10 pips against you? That's a $100 loss. A 50 pip move against you, which can happen in minutes or even seconds during a volatile news event, translates to a $500 loss. That's a staggering 25% of your entire account, vaporized on a single trade from a price move you can barely see on a chart. This is the double-edged sword. Leverage doesn't just amplify your potential gains. It amplifies your potential losses at the exact same rate. It magnifies everything. It turns the gentle whispers of the market, the tiny pip movements, into shouts that can have a massive impact on your account balance. This brings us to the next crucial piece of the puzzle: margin. If the broker is letting you control $100,000 with only $2,000 of your own, how do they protect themselves? What's to stop you from losing more money than you have in your account, leaving them with the bill? The answer is margin. Margin is not a fee. It is not a transaction cost. Think of margin as a good faith deposit or collateral. It's a portion of your account funds that your broker sets aside to secure your open position and cover any potential losses. When you use leverage to open a trade, a certain amount of your account is locked up as used margin or required margin. Let's stick with our example. You have a $2,000 account and want to open a $100,000 standard lot using 50-to-1 leverage. The margin requirement is calculated as the inverse of your leverage ratio. So for 50-to-1 leverage, the margin requirement is 1 divided by 50, which is 2%. You need to put up 2% of the total position size as a deposit. 2% of $100,000 is $2,000. So to open this trade, your broker will lock up your entire $2,000 account as the required margin. The moment you click buy or sell, that money is held as collateral. Now what happens as the trade plays out? The part of your account that is not locked up as required margin is called free margin or usable margin. This is the money you have available to open new trades or to absorb losses from your current trades. In our first scenario, where your whole account was the required margin, your free margin was 0. This is an extremely dangerous position to be in. Let's adjust the scenario to make it more realistic. Say you have a $5,000 account. You still open that $100,000 position using 50-to-1 leverage. The required margin is still $2,000. Your broker sets that aside. Now your account looks like this. Your total equity is $5,000. Your used margin is $2,000. That leaves you with $3,000 of free margin. This $3,000 cushion is what keeps your trade alive if the market moves against you. Every tick the market moves against you, the unrealized loss is subtracted from your free margin. Let's say the trade goes against you by 100 pips. At $10 a pip, that's a $1,000 floating loss. Your account equity drops from $5,000 to $4,000. Your used margin is still $2,000, but your free margin has now shrunk from $3,000 down to $2,000. You're eating into your safety net. If the losses continue to mount, you approach a terrifying moment that every trader dreads: the margin call. A margin call is a warning from your broker. It's an automated alert that your account is in trouble. It happens when your account equity falls to a certain percentage of your used margin, often called the margin level. If your margin level hits, say, 100%, it means your total account equity is now equal to the amount of margin being held for your trade. In our example, this would happen if your losses reach $3,000, because your initial $5,000 equity would drop to $2,000, which is the same as your used margin. At this point, your free margin is 0. You have no more cushion. The broker is essentially saying, you need to deposit more funds immediately, or you need to start closing positions to free up margin, because you are on the verge of total failure. But it gets worse. If you don't or can't act, and the trade continues to move against you, you hit the final brutal checkpoint: the stop-out level. The stop-out level is an even lower margin level, for instance 50%. When your equity drops to this point, in our case when it falls to just $1,000, 50% of the $2,000 used margin, the broker system takes over. It doesn't ask for your permission. It doesn't wait. It will automatically and immediately start closing your losing trades, starting with the biggest loser first. This is not to be mean. It's a self-preservation mechanism for the broker. They are liquidating your position to ensure your losses don't exceed the funds in your account, which would leave them liable. For the trader, this is the moment your account gets blown up. It's a forced liquidation at the worst possible price, cementing your losses. Understanding this chain reaction is non-negotiable. PIP is just a measurement, but when combined with a lot size that is amplified by leverage, that PIP's value can rapidly eat through your free margin. Once the free margin is gone, you get the margin call. And if the losses continue, the stop-out liquidates your position and shatters your account. This is how traders, seduced by the power of high leverage, can lose their entire capital on a single trade. They fail to respect the relationship between pips, position size, and the margin required to weather the storm. They use too much of the lever and the boulder comes crashing back down on them. So the question becomes, how do you prevent this? How do you use the power of leverage without being destroyed by it? How do you calculate the exact risk on every single trade before you even click the buy or sell button, so you know with certainty that a margin call isn't even a remote possibility? That involves understanding position sizing. And it's the single most important risk management skill that separates seasoned traders from those who are just gambling. It's the mechanism that allows you to precisely dial in your risk before you ever click the buy or sell button. Think of it like being the captain of a ship. You can't control the weather, the storms, the waves, the unpredictable currents of the market, but you absolutely can control the size of your rudder and how you steer your ship through those waters. Position sizing is how you steer. It's the difference between navigating a storm and being capsized by it. So what is it exactly? In the simplest terms, position sizing is the process of deciding how many units of a currency you're going to trade, based on how much of your account you're willing to risk on that single idea. It's not a gut feeling. It's not about how confident you are. It's a cold, hard calculation, and it's built on 3 core pillars. Get these 3 things right, and the entire risk management puzzle starts to solve itself. The first pillar is the easiest one, your account size. This is simply the total amount of capital you have in your trading account. For the sake of a clean example, let's say you have a $10,000 account. That's our starting point, $10,000. The second pillar is where you, the trader, have to make a critical decision. It's your account risk percentage. This is the maximum percentage of your total account that you are willing to lose on any single trade. Now you'll hear a lot of talk in trading circles about the 1% rule or the 2% rule. There's a very good reason for this, and it's rooted in the brutal mathematics of losses. If you risk 10% of your account on a trade and lose, your account drops to $9,000. To get back to your original $10,000, you now need to make a gain of over 11%. If you lose 20%, you need a 25% gain to break even. And if you have a catastrophic loss of 50%, taking your $10,000 account down to $5,000, you now need to achieve a monumental 100% return just to get back to where you started. The deeper the hole you dig, the exponentially harder it is to climb out. The 1% rule is a defense mechanism against this destructive math. If you risk just 1% of your $10,000 account, you're risking $100. If you lose, your account drops to $9,900. The gain needed to get back to even is just a little over 1%. It's manageable, keeps you in the game. It allows you to be wrong, and you will be wrong many times without destroying your ability to trade. So, for our example, we'll use the widely respected 1% rule. Our maximum risk on this next trade will be $100. Not a penny more. This number is our line in the sand. Now for the third pillar, and this is where our understanding of pips becomes absolutely crucial. The third pillar is your stop-loss distance. A stop-loss is a preset order you give your broker to automatically close your trade if the price moves against you by a certain amount. It's your safety net. It's the emergency exit. It ensures that a losing trade is just a small, controlled loss, not a financial disaster. The distance between your entry price and your stop-loss price is measured in pips. Now, where you place this stop-loss is a science in itself, often based on technical analysis, things like recent highs or lows or key support and resistance levels. The key thing to understand is that the placement isn't random. It's a strategic decision based on the market's behavior. Let's imagine we're looking at the euro to US dollar currency pair. We believe the price is going to go up and we want to buy at the current market price of, say, 1.0750. Based on our analysis of the chart, we decide that if the price drops down to 1.0700, our trade idea is proven wrong, and we need to get out. So we decide to place our stop-loss at 1.0700. The distance between our entry at 1.0750 and our stop-loss at 1.0700 is 50 pips. So we now have all 3 pillars: a $10,000 account, a 1% risk tolerance which equals $100, and a 50 pip stop-loss distance. Now we put it all together. This is the moment where most new traders make a catastrophic mistake. They know what a standard lot is, 100,000 units of currency, and they know from our previous discussions that on a pair like euro to US dollar, one standard lot means each pip of movement is worth about $10. So they say, okay, I'll trade one standard lot. Let's follow that logic. If they trade one standard lot where each pip is worth $10, and their stop-loss is 50 pips away, what is their actual risk? It's 50 pips multiplied by $10 per pip. That's $500. Their intended risk was $100. Their actual risk is $500. They are risking 5% of their account, Not the 1% they planned on. One bad trade and they've just wiped out 5% of their capital. Two of those in a row and they're down a quick 10%, digging that hole we talked about. This is how accounts get blown up. This is how people fail. The professional trader does it differently. They use the 3 pillars to calculate their position size before they trade. The logic is simple. They ask, if my total risk allowed is $100 and my stop loss is 50 pips away, how much can I afford to risk per pip? The math is straightforward. $100 divided by 50 pips equals $2 per pip. That is the magic number. $2 per pip. That's the absolute maximum value each pip can have for this specific trade to align with our risk management rules. The final step is to determine what position size gives us a pip value of $2. We know a standard lot is $10 per pip. That's too big. We know a mini lot, which is 10,000 units, is $1 per pip. That's getting closer. And a micro lot, 1,000 units, is 10 cents per pip. So, to get a value of $2 per pip, what do we need? We need to trade 2 mini lots. 2 mini lots will make each pip movement worth $2. Or, if your broker allows for more flexible sizing, you could trade 20 micro lots, which also equals $2 per pip. The total size of our position is 20,000 units of currency. Now look at what happens. The professional trader enters the exact same trade at 1.0750, with the exact same 50 pip stop loss at 1.0700. But instead of trading a random standard lot, they trade a precisely calculated position of 2 mini lots. If the trade goes against them and hits their stop loss, their loss is 50 pips multiplied by their new pip value of $2. The total loss is exactly $100. 1% of their account. Exactly as planned. They have successfully bent the market's risk to their will. They didn't guess. They didn't hope. They calculated. They controlled the only thing they could truly control, how much they stood to lose. This single skill is the foundation upon which all successful trading careers are built. It transforms trading from a reckless game of chance into a strategic business of managing probabilities. So now you know exactly how to calculate your position size to control your risk on every single trade. You've built your shield. But how do you build your sword? How do you ensure that your winning trades are big enough to matter, big enough to cover your small, controlled losses and still grow your account? That's where we talk about the other side of the equation. The reward. It's all about the risk-to-reward ratio. And it's how traders aim to build long-term profitability. So what exactly is a risk-to-reward ratio? At its core, it's one of the simplest yet most powerful concepts in all of trading, and it's the engine that drives a professional trading plan. Forget complex algorithms for a moment. Forget fancy indicators. This is about basic fundamental math. The risk-to-reward ratio simply compares the amount of money you are risking on a trade to the amount of potential profit you are trying to make. Let's break it down with an analogy completely outside of trading. Imagine you and a friend are making a simple bet on a coin flip. You bet $10. If you lose your $10. That's your risk. If you win, your friend gives you back your $10 plus another $10. That's your reward. In this case, you are risking $10 to make $10. We would call this a 1-to-1 risk-to-reward ratio. For every $1 you risk, you stand to make $1 in profit. Now imagine a different bet. You risk $10, but if you win, your friend agrees to pay you $30 in profit. Now you're risking $10 to potentially make $30. This is a 1-to-3 risk-to-reward ratio. For every $1 you risk, you stand to make $3. See how that works? It's a simple comparison of what you could lose versus what you could gain. In Forex, we don't use dollars for this initial calculation. We use pips. The distance from your entry point to your stop loss is your risk, measured in pips. The distance from your entry point to your take profit target is your potential reward, also measured in pips. Let's say you believe the euro is going to strengthen against the US dollar, so you decide to buy the euro to US dollar pair at a price of 1.0750. Based on your analysis, you place your protective stop loss at 1.0730. The distance between your entry and your stop loss is 20 pips. That is your risk. You are risking 20 pips on this trade. Now you set your profit target at 1.0810. The distance between your entry and your target is 60 pips. That is your potential reward. So you are risking 20 pips to potentially make 60 pips. Your risk-to-reward ratio is 20 to 60, which simplifies down to 1 to 3. This is where everything we've learned comes together. And it's the moment where many aspiring traders have a massive breakthrough. Let's imagine two traders, we'll call them Charlie and David. Both start with the exact same account size. Both are trading the same currency pair. Both are decent analysts, but they have one critical difference in their trading philosophy. Charlie believes in being right. He hates losing. So he sets his profit targets very close to his entry price, making them easy to hit. He risks 20 pips on every trade, and he aims to make 20 pips on every trade. He's using a 1-to-1 risk-to-reward ratio. Because his targets are so close, he has a pretty good win rate. Let's say he wins 60% of his trades, which sounds fantastic to a beginner. David, on the other hand, understands that his winners need to pay for his losers. He's accepted that losing is part of the business. He also risks 20 pips on every trade just like Charlie. But David is more patient. He sets his profit target 60 pips away. He's using a 1-to-3 risk-to-reward ratio. Because his target is further away and harder to reach, his win rate is lower. Let's say David is only right 40% of the time. Now let's watch them both take 10 trades. Charlie, with his 60% win rate, wins 6 out of his 10 trades. His 6 winning trades each make him 20 pips. So 6 times 20 equals 120 pips in profit. But he also lost 4 trades. His 4 losing trades each cost him 20 pips. So 4 times 20 equals 80 pips in losses. At the end of his 10 trades, Charlie has a net profit of 120 minus 80, which is 40 pips. Not bad. He was right most of the time and made a small profit. Now let's look at David. David, with his lower 40% win rate, only wins 4 out of his 10 trades. His 4 winning trades each make him 60 pips. So 4 times 60 equals 240 pips in profit. He lost the other 6 trades. His 6 losing trades each cost him 20 pips. So 6 times 20 equals 120 pips in losses. At the end of his 10 trades, David has a net profit of 240 minus 120, which is 120 pips. Let that sink in for a second. David was wrong more often than he was right. He lost 60% of his trades. He felt the sting of a losing trade more frequently than Charlie did. And yet, at the end of the day, David made 3 times more profit than Charlie. This is the mathematical edge. This is the secret that separates many struggling traders from those who find consistency. It's a profound mental shift. The goal is not to win every trade. The goal is to make more money on your winning trades than you lose on your losing trades over a large series of trades. A positive risk-to-reward ratio like the one David used gives you a buffer. It means you don't have to be perfect. You can be wrong, you can have a losing day, you can even have a losing week, and still have a profitable month or year because your winners are powerful enough to erase multiple losses. This is also one of the hardest psychological hurdles to overcome in trading. Our brains are wired to want to be right. A losing trade feels like a failure. A winning trade, even a tiny one, feels like a success. That's why so many beginners fall into Charlie's trap. They cut their winners short at the first sign of profit just to lock in that feeling of being right. But they let their losers run, hoping they'll turn around, often turning a small manageable loss into a catastrophic one. A professional mindset like David's flips this on its head. It embraces small, controlled losses as a simple cost of doing business, like a restaurant owner accepting that some food will spoil. It's an expected expense. But when a trade works, they are patient. They let it run. They let their analysis play out. They aim for the larger targets because they know that one good trade can pay for 2, 3, or even 4 previous losses. Now, there is no single magic ratio. A 1-to-3 ratio isn't a universal rule. Some short-term strategies known as scalping might operate on a 1-to-1 ratio but rely on a very high win rate, maybe 70 or 80%, to be profitable. Other long-term trend-following strategies might aim for a 1-to-5 or even 1-to-10 ratio, accepting that they might only win 20 or 30% of their trades. They might take 10 small losses in a row, waiting for that one massive home run trade that defines their entire year. The key isn't the specific number. It's the intention. It's about consciously defining your risk and your potential reward on every single trade before you ever click the buy or sell button. And the unit you use to define it all? The pip. Your risk is a number of pips. Your reward is a number of pips. This simple ratio, built upon the foundation of the pip, is what transforms trading from a gambling exercise into a strategic business. But this brings us to the most practical question of all. We've talked about pips as a measure of distance. We've talked about lot sizes as a measure of volume. We've talked about risk to reward as a strategic ratio. But how does it all translate into the one thing that really matters? The dollars and cents in your US trading account. How much is one pip actually worth? When you risk 20 pips, are you risking 20 cents, $20, or $200? The answer depends on your lot size and the currency pair you're trading, and calculating it is the final piece of the puzzle. Let's start with the most important concept that determines the dollar value of a pip: the lot size. Think of a lot size as the size of your order. In the stock market, you might buy 10 shares of Apple or 100 shares of Ford. In Forex, you trade in standardized blocks of currency called lots. This is how the market maintains order. Without these standardized sizes, it would be chaos, like a grocery store where you could ask for exactly 17 grains of rice. Instead, they sell you a 1-pound bag or a 5-pound box. Forex is the same. There are 3 main lot sizes you'll encounter every single day. First, you have the standard lot. This is the big one. A standard lot is 100,000 units of the base currency. So if you're trading the euro to US dollar, one standard lot is a position worth 100,000 euros. Now I know what you're thinking. 100,000 euros? I don't have that kind of money sitting around. And you don't need it. We'll get to the magic of leverage in a later part, but for now, just know that a standard lot is the professional grade institutional size position. It's the 5-pound box of rice. Next, and far more common for retail traders like us, is the mini lot. A mini lot is exactly 1/10 of a standard lot, so it's 10,000 units of the base currency. If you're trading US dollar to Japanese yen, one mini lot is a position worth 10,000 US dollars. This is a much more manageable size for individual traders and is incredibly popular. This is your 1-pound bag of rice, the standard for home use. Finally, we have the micro lot. This is the beginner's best friend. A micro lot is 1/10 of a mini lot, which means it's 1,000 units of the base currency. A micro lot of euro to US dollar is a position worth 1,000 euros. This size is perfect for learning because it allows you to trade with real money and experience real market movements, but with significantly reduced risk. It's like buying a single serving cup of rice to see if you even like it before you commit to the big bag. Some brokers even offer nano lots, which are just 100 units, but micro lots are generally the smallest practical size for most traders. So standard is 100,000, mini is 10,000, and micro is 1,000. These numbers are the key. They are the multiplier that turns a tiny pip movement into a tangible profit or loss. Now for the math, and I want you to stay with me here. It might look a little intimidating at first, but I promise it's simple once you see it in action. Plus, the good news is your trading platform does all of this for you automatically. But a world-class trader understands what the computer is doing. You need to know the why behind the numbers. The basic formula to calculate the value of one pip is a pip in decimal form, divided by the current exchange rate, multiplied by your lot size. Let's break that down with the easiest possible example. A currency pair where the US dollar is the second currency listed. The quote currency. The most popular pair in the world, the euro to US dollar, is a perfect example. Let's say the euro to US dollar is trading at 1.0850. You decide to trade one mini lot, which is 10,000 units. A pip, as we know, is 0.0001. So we take the pip in decimal form, 0.0001, and divide it by the exchange rate, 1.0850. Then we multiply that result by our lot size, 10,000. The result is the pip value in the quote currency, which in this case is the US dollar. But wait, there's a massive shortcut here. For any pair where the USD is the quote currency, like euro to US dollar, pound sterling to US dollar, Australian dollar to US dollar, the pip value is fixed and incredibly easy to remember. You don't even need to do the complex calculation every time. For a standard lot, 100,000 units, one pip is worth exactly $10. For a mini lot, 10,000 units, one pip is worth exactly $1. For a micro lot, 1,000 units, one pip is worth exactly 10 cents. That's it. It's that simple. Let's make this real. Imagine you're trading euro to US dollar with a micro lot. You think the price is going to go up, so you buy. The price moves 15 pips in your favor. Since each pip is worth 10 cents with a micro lot, you've just made 15 times 10 cents, which is $1.50. If you had used a mini lot, that same 15 pip move would have netted you $15. And with a standard lot, that's $150. See how the lot size is the volume knob for your risk and reward? The number of pips is the song, but the lot size is how loud you're playing it. Okay, but what happens when the US dollar is the first currency in the pair? The base currency? like the US dollar to Japanese yen, or the US dollar to Swiss franc, or the US dollar to Canadian dollar. Here the calculation changes slightly, and the pip value is no longer fixed. It fluctuates as the exchange rate moves. Let's use US dollar to Swiss franc as our example. Let's say it's trading at 0.9125. Remember our formula: pip in decimals / exchange rate, asterisk lot size. Let's calculate the value for a mini lot, 10,000 units. The pip is 0.0001. We divide that by the exchange rate, 0.9125. That gives us a tiny number. Then we multiply that by our lot size, 10,000. The result is approximately 1.095. But what currency is that? The formula always gives you the value in the quote currency. In US dollar to Swiss franc, the quote currency is the Swiss franc, CHF. So 1 pip is worth about 1 Swiss franc and 10 Rappen. As a US trader, you need to know what that is in dollars. So you'd have to convert it back. But our formula already did that. The value of the pip is about $1.095. Notice it's not exactly $1 anymore. It's a little bit more. If the US dollar to Swiss franc exchange rate were to fall to, say, 0.9000, the pip value would increase to about $1.11. If the rate rose to 0.9500, the pip value would decrease to about $1.05. The key takeaway is this: when the USD is the base currency, the value of a pip changes along with the exchange rate. It's not a huge change from pip to pip, but it's something a professional trader is aware of. A 10-cent difference per pip on a large position can add up. Now for the final, most complex scenario: cross-currency pairs. These are pairs that don't involve the US dollar at all, like the euro to pound sterling, or the AUD/NZD, or the pound sterling to Japanese yen. Let's say you, a US-based trader, want to trade the euro to Japanese yen. Your account is in USD, but the transaction involves euros and Japanese yen. How on earth do you figure out the pip value in dollars? Let's imagine the euro to Japanese yen is trading at 162.50. And let's remember that for yen pairs, a pip is the second decimal place, so 0.01. We'll trade 1 mini lot, which is 10,000 euros. First, we use our formula to find the pip value in the quote currency, which is Japanese yen. Open parenthesis 0.01 divided by 162.50 close parenthesis times 10,000 is equal to 0.615. So 1 pip is worth 0.615 Japanese yen. Wait, that can't be right. Let's recheck that. My mistake. The lot size is 10,000 units of the base currency, so it's 10,000 euros. The formula is pip size * lot size / exchange rate. Let me give you an easier way. A much easier way. Let's reset. For a cross-currency pair like euro to Japanese yen, we first find the pip value in the quote currency, JPY. A mini lot is 10,000 units. 1 pip is 0.01. So 1 pip movement on a 10,000 euro position is 10,000 times 0.01, which is 100. The value of 1 pip is 100 Japanese yen. Now, as a US trader, you need to know what 100 yen is worth in your currency, US dollars. To do that, you just look at the current exchange rate for US dollar to Japanese yen. Let's say US dollar to Japanese yen is trading at 150.00. This means 150 yen equals 1 US dollar. So to find the dollar value, you take the pip value in yen, 100 Japanese yen, and divide it by the US dollar to Japanese yen exchange rate, 150. 100 divided by 150 is about 0.66. So for this trade, 1 pip is worth approximately 66 cents. I know that was a whirlwind of numbers. And I want to be crystal clear, you will likely never ever have to do that calculation by hand. Why? Because we live in the 21st century. Every single trading platform instantly tells you the dollar value of your potential trade. There are also dozens of free online pip value calculators where you just plug in the currency pair, your lot size, and it spits out the exact value in a fraction of a second. So why did we just spend 5 minutes going through the math? Because understanding the mechanics is what separates a gambler from a trader. A gambler just throws money at something. A trader understands the underlying structure of their position. You now know why a pip on euro to US dollar is worth a different amount than a pip on US dollar to Canadian dollar, and why both are different from a pip on euro to Japanese yen. This knowledge is the foundation of risk management. When a professional trader says, "I'm going to risk 20 pips on this trade," they don't just see the number 20. They see the equation. They know that on euro to US dollar with a standard lot, 20 pips is a $200 risk. But with a micro lot, it's only a $2 risk. They know that on US dollar to Swiss franc, that 20 pip risk might be $22, not $20. Knowing how to calculate pip value, even if you just use a calculator to do it, empowers you to precisely control your risk on every single trade. You can decide exactly how many dollars you are willing to put on the line, and then adjust your lot size accordingly to match your desired pip risk. This is a non-negotiable skill for long-term survival in the markets. You've now conquered the concept of the pip, the pipette, and the all-important pip value. You understand the machinery, but there's one more piece to this puzzle. It's a concept that acts as a massive amplifier for everything we've just discussed. It's what allows a trader with a $1,000 account to control a $10,000 mini lot, or even a $100,000 standard lot. It's a tool that can magnify your gains, but it can also magnify your losses at an astonishing speed. It's called leverage. And understanding how leverage and margin work with pips and lot sizes is the final step to truly grasping your financial exposure in the Forex market. Imagine you want to move a 1-ton boulder. You could try to push it with your bare hands and you'd get nowhere. But what if I handed you a giant lever? A small push on your end could send that massive rock tumbling. That, in essence, is what leverage does in the Forex market. It's a tool provided by your broker that allows you to control a large amount of currency with a relatively small amount of your own capital. It's the financial equivalent of that giant lever. When you open a trading account, you'll see leverage offered as a ratio like 50-1 or 100-1. In the United States, for major currency pairs, this is typically capped at 50-1 for retail traders. So what does that 50-1 ratio actually mean? It means for every $1 of your own money, your broker will let you control $50 in the market. Let's make this real. Say you deposit $1,000 into your trading account. With 50-1 leverage, you don't just control $1,000. You now have the potential to control $50,000 of currency. Your $1,000 acts as a sort of good faith deposit to control that much larger position. This deposit has a special name, margin. This is a point that trips up so many new traders. Margin is not a fee. It's not a cost you pay to the broker. Think of it like a security deposit when you rent an apartment. You give the landlord the deposit, not as a payment, but as collateral to cover any potential damages. You get it back when you move out, assuming everything is in good shape. In trading, your margin is a portion of your account equity set aside by your broker to cover any potential losses on your trade. It's your skin in the game. So, you have your $1,000 account. You want to open a trade to control $50,000 of euro to US dollar, using that 50-1 leverage. The broker will lock up that $1,000 from your account as the required margin for that position. This is now called used margin. The money left over in your account that you could use to open other trades is called free margin or usable margin. Your total account value, your cash, plus or minus any profits or losses from open trades, is called your equity. Now let's connect all the dots we've laid out so far: pips, lot sizes, and now leverage and margin. This is where the magic and the danger truly reveals itself. You've used your $1,000 of margin to take a $50,000 position in the euro to US dollar. Remember our lot sizes? A standard lot is 100,000 units. A mini lot is 10,000 units. So a $50,000 position is equivalent to 5 mini lots. We calculated earlier that for a mini lot of euro to US dollar, 1 pip of movement is worth about $1. Since you're trading 5 mini lots, every single pip move is now worth $5 to you. Let's say you were right. The euro to US dollar moves up by 20 pips in your favor. Your profit would be 20 pips multiplied by $5 per pip, which equals $100. Think about that for a second. You made $100 from a tiny market fluctuation, all starting with your $1,000 deposit. That's a 10% return on your initial capital. Without leverage, if you had only traded your own $1,000, that same 20 pip move would have earned you just $2. You see the power? Leverage took a potential $2 gain and magnified it into a $100 gain. It amplified your trading power by a factor of 50. But here is the part that demands your absolute respect. The lever works in both directions. That double-edged sword has another side. What if the trade went against you? What if the euro to US dollar dropped by 20 pips instead? Well, that's 20 pips multiplied by a negative $5 per pip. You've just lost $100. That loss comes directly out of your account equity. Your $1,000 account is now worth $900. A 10% loss. A small, almost insignificant flicker in the world's largest market just took a very real, very significant bite out of your capital. This is why understanding leverage is not just about seeing the upside. It's about deeply, fundamentally respecting the downside. The higher the leverage, the less room for error you have. A small move against you can wipe out a substantial portion of your account. And this brings us to one of the most feared phrases in trading: the margin call. A margin call isn't a friendly phone call from your broker. It's an automated red alert from your trading platform. Remember how your broker set aside your $1,000 as used margin to cover potential losses? Well, what happens if your losses get so big they start to eat through nearly all of your account equity? Let's say your trade goes horribly wrong. The market plummets 180 pips against you. At $5 a pip, that's a $900 loss. Your initial $1,000 account now only has $100 of equity left. Your broker sees this and realizes that if the market moves just a little bit further against you, your losses will be bigger than the total amount of money in your account. You would then owe them money, and brokers are not in the business of letting that happen. So, to protect themselves, they trigger a margin call. Their system will automatically close out your losing position. Poof! Your trade is gone. You're left with the remaining $100 in your account. You've lost 90% of your capital. This is how accounts get blown up. A trader, seduced by the power of high leverage, takes on a position that is far too large for their account to handle. A single bad trade, magnified by leverage, turns into a catastrophic loss. Leverage doesn't change whether a trade is good or bad. It only changes the consequences. It makes your winners bigger, and it makes your losers devastatingly bigger. It's an accelerant. It pours gasoline on both your profits and your losses. So, as a US trader, you are somewhat protected by that 50-to-1 leverage cap. In some other parts of the world, brokers offer insane leverage like 500-to-1 or even 1,000-to-1. While that might sound exciting, it's a recipe for disaster for an inexperienced trader. A tiny fractional price move can vaporize an entire account in seconds. The US regulations are there for a reason, to prevent that exact scenario. Understanding the relationship between pips, lot size, leverage, and margin is the absolute bedrock of risk management. When you look at a potential trade, you can no longer just think, I think the euro is going up. You must now think, okay, if I enter this trade with too many lots, my pip value will be $2. My account is $5,000. If this trade moves against me by 50 pips, that would be a $100 loss, which is 2% of my account. Am I comfortable with that level of risk for this potential reward? That calculation, that single piece of critical thinking, is what separates disciplined traders from gamblers. It's how you shift from simply guessing the market's direction to strategically managing your financial exposure. You have now seen the full picture of how a tiny pip, a flicker on a chart, translates into real dollars won or lost in your account. You understand the engine of Forex, the lot size that determines your scale, and the high-octane fuel of leverage that determines your speed. You now possess the knowledge of how this machine works. But knowing how an engine works and knowing how to safely drive a race car are two very different things. You have this incredible power at your fingertips, this ability to magnify your market exposure. The critical question that remains is, how do you control it? How do you keep that double-edged sword from turning against you and ensure you stay in the game for the long haul? The answer is a two-word phrase that separates amateur speculators from professional traders. It's the difference between a gambler pulling a slot machine lever and a pilot running through a pre-flight checklist. That phrase is risk management. Sounds boring, I know. Sounds like something from an accounting textbook. But in the world of trading, risk management is not the brakes on your race car. It's the entire steering system, the roll cage, and the fire suppression unit. It's what allows you to push the engine to its limits, knowing you have systems in place to handle a spin-out. Without it, leverage isn't a tool. It's a ticking time bomb strapped to your capital. So, how do you actually manage risk on a trade-by-trade basis? It starts with accepting a fundamental truth. You will be wrong. A lot. The best traders in the world are often wrong 40 to 50% of the time. Think about that. They are no better at predicting the future than a coin flip. Their edge doesn't come from a crystal ball. It comes from controlling the damage when they're wrong and maximizing the opportunity when they're right. They achieve this with two of the most powerful orders you have at your disposal: the stop loss and the take profit. Let's start with the most important one, the stop loss order. A stop loss is your predefined ejection seat. It's an order you place with your broker that says, If the market moves against me and my trade loses a certain amount of money, or hits a specific price, get me out immediately. No questions asked. It's your automated line in the sand. It's you, in a calm, rational state of mind, telling your future emotional self, this is the absolute maximum pain we are willing to tolerate on this one idea. Period. Let's go back to our euro to US dollar example. You believe the euro is going to strengthen against the dollar, so you buy one mini lot at a price of 1.08500. Your analysis, the very reason you entered the trade, would be invalidated if the price dropped back down to, say, 1.08300. That level represents the point where your trade idea is officially wrong. So when you place your buy order, you also place a stop-loss order at 1.08300. The distance between your entry, 1.08500, and your stop-loss, 1.08300, is 20 pips. You have just defined your risk. You have quantified it. It's no longer a vague fear. It's a number, 20 pips. If you're trading a mini lot, where each pip is worth about $1, you have just made a conscious decision that you are willing to risk approximately $20 on this trade to see if your idea is correct. If the price turns and drops, the moment it touches 1.08300, your broker system automatically closes your position. You take the $20 loss and you move on to the next opportunity. You live to fight another day. The stop loss prevents a 20 pip loss from spiraling into a 100 pip loss that cripples your account because you were frozen by hope, fear, or indecision. Now let's talk about the fun part, getting paid. This is where the take profit order comes in. A take profit is the mirror image of a stop loss. It's an order that says, if this trade moves in my favor and hits my predetermined target price, get me out and lock in my gains. It's the antidote to greed. Greed is the voice that whispers, look how well this is going. Let's hold on for just a little more. Right before the market violently reverses and erases all your hard-won gains. In our euro to US dollar trade, you bought at 1.08500 with a 20 pip stop loss at 1.08300. Your analysis suggests that if the price breaks upward, it has a strong potential to reach 1.09100. So you place a take profit order at 1.09100. The distance between your entry, 1.08500, and your target, 1.09100, is 60 pips. With your mini lot, that represents a potential profit of about $60. If the market rallies and touches that price, your broker automatically closes the trade, and that $60 profit is deposited into your account balance. The trade is over. You won. You followed your plan. You didn't get greedy and hope for 100 pips, only to watch it fall back to your entry price. Now here's where it all comes together. This is the math that underpins a sustainable trading career. We just created a trade with a risk of 20 pips and a potential reward of 60 pips. This is known as a risk-to-reward ratio. In this case, for every one part of risk, you have the potential for 3 parts of reward. We call this a 1-to-3 risk-to-reward. Why is this so critically important? Because with a ratio like this, you can be wrong more often than you are right and still come out ahead. Let's imagine you take 10 trades with this exact 1-to-3 structure. Let's say you have a terrible week, and 7 of those trades are losers. They hit your stop loss. You lose 20 pips on each of those 7 trades. That's a total loss of 140 pips. But the other 3 trades were winners. They hit your 60 pip take profit target. That's a total gain of 180 pips. So, after 10 trades where you were wrong 70% of the time, you are still up 40 pips, 180 pips in gains minus 140 pips in losses. This is not magic. It's mathematics. It's the core of positive expectancy. Your profitability over the long run is not determined by being a perfect predictor, but by ensuring your average winning trade is significantly larger than your average losing trade. This brings us to the final and perhaps most crucial element of control, position sizing. This is the master dial that connects your pip risk to your actual bank account. Position sizing answers the question, how many lots should I trade? The answer is not based on a gut feeling or how confident you are. It's based on your stop loss and a predetermined percentage of your account you are willing to risk. A widely accepted guideline in the trading community, especially for those starting out, is to never risk more than 1% to 2% of your total trading capital on any single trade. Let's make this real. Imagine you have a $5,000 trading account. Following the 1% rule, the absolute maximum amount of money you should risk on one trade is $50. Now let's go back to our euro to US dollar trade idea. We know our stop loss is 20 pips away from our entry. We know our maximum dollar risk is $50. The only question left is the position size. We need to figure out a lot size where those 20 pips of risk equal $50. So we work backwards. We take our max dollar risk, $50, and divide it by our pip risk, 20 pips. The result is $2.50. That means we need our pip value to be $2.50. We know a mini lot has a pip value of about $1. A standard lot has a pip value of about $10. So to get a pip value of $2.50, we would need to trade 0.25 mini lots, or what's known as 2.5 microlots. Most modern platforms allow for this level of precision. Do you see the power in this? You didn't just guess your size. You used your account balance, your risk tolerance, and your specific trade analysis to calculate the exact appropriate position size. The market can do whatever it wants, can be completely unpredictable, but you, the trader, have controlled the only thing you truly can, your potential loss. You have defined it down to the penny before you even entered the market. This is how you wield the double-edged sword of leverage without getting cut. This is how you transform pips from abstract price fluctuations into a manageable, quantifiable component of a professional business plan. This methodical, calculated approach is what separates a flash in the pan from a trader who can navigate the markets for years to come. And this is where the rubber truly meets the road. It's the point where we graduate from the academic understanding of a pip to the practical, dollars and cents reality of what it means for your trading account. Because knowing a pip is the fourth decimal place is one thing. Knowing exactly how much money that fourth decimal place represents is everything. This is the bridge between theory and profit, between knowing the game and actually playing it to win. So let's ask the $1 million question, or more accurately the $10 question, as you'll soon see. What is a pip actually worth? The answer, like many things in Forex, is it depends. It depends on two critical factors: the currency pair you're trading and, most importantly, the size of your position, also known as your lot size. Let's break down lot sizes first, because this concept is the engine that determines the financial horsepower of every single pip move. In the world of Forex, you don't just buy some currency. You buy or sell it in standardized amounts or lots. Think of it like buying eggs. You don't go to the store and ask for one egg. You buy a dozen. Lots are the Forex equivalent of a carton of eggs. There are three main lot sizes you'll encounter constantly. First, the big one, the standard lot. A standard lot is 100,000 units of the base currency. So if you're trading the euro versus the US dollar, or euro to US dollar, one standard lot is 100,000 euros. This is the playing field for institutional traders and those with significant capital. Next, we have the mini lot. A mini lot is 1/10 of a standard lot, or 10,000 units of the base currency. Using our euro to US dollar example, one mini lot is 10,000 euros. This size is far more accessible for serious retail traders, offering a good balance between risk and potential reward. Finally, we have the micro lot. A micro lot is 1/10 of a mini lot, which means it's 1,000 units of the base currency. One micro lot of euro to US dollar is 1,000 euros. This is the ideal starting point for beginners, as it allows you to trade with real money, but with significantly reduced risk, letting you learn the ropes without catastrophic consequences. Some brokers even offer nano lots of 100 units, but standard, mini, and micro are the universal benchmarks. Now let's connect these lot sizes to the value of a pip. This is where the light bulb goes on. The calculation is surprisingly straightforward, especially for pairs where the US dollar is the second currency listed. The quote currency, like the euro to US dollar, pound sterling to US dollar, or Australian dollar to US dollar. For these pairs, the value of a pip is fixed and easy to remember. For a standard lot of 100,000 units, one pip is worth exactly $10. Simple. If you buy euro to US dollar and the price goes up by 10 pips, your position has increased in value by $100. If it goes down by 5 pips, you're looking at a $50 unrealized loss. For a mini lot of 10,000 units, one pip is worth exactly $1. That 10 pip move is now worth $10. The 5 pip move is worth $5. You can see how the risk is reduced tenfold. And for a micro lot of 1,000 units, one pip is worth 10 cents. That same 10 pip move? It's worth $1. The 5 pip move is just 50 cents. This is why micro lots are so valuable for learning. You can experience the mechanics and emotions of trading without putting significant capital on the line. So for any pair ending in USD, it's simple. $10, $1, or 10 cents per pip. But what about pairs that don't have the US dollar as the quote currency? What about a pair like US dollar to Japanese yen? Or a cross-currency pair like euro to Japanese yen? This is where one extra simple step comes in, but the logic is identical. Let's take euro to Japanese yen. Remember, for yen pairs, a pip is the second decimal place, not the fourth. Let's say you buy one standard lot. That's 100,000 euros. The pip is 0.01. The value of one pip is calculated in the quote currency, which in this case is the Japanese yen. So we take the pip, 0.01, and multiply it by the lot size, 100,000. That gives us 1,000. So one pip is worth 1,000 Japanese yen. But as a US trader, you need to know what that is in dollars. To find out, you just perform a simple currency conversion. You take that 1,000 yen and divide it by the current exchange rate for US dollar to Japanese yen. If the US dollar to Japanese yen rate is, say, 150.00, then you divide 1,000 by 150. Your pip value is approximately $6.67. Your broker's platform does all this for you automatically, displaying your profit and loss in US dollars in real time. But understanding the mechanics behind it is what separates a button pusher from a trader. You need to know why the numbers are what they are. This knowledge of pip value and lot sizes isn't just trivia. It is the absolute cornerstone of professional risk management. Without it, you are flying blind. Every professional trader on the planet, before they even think about clicking the buy or sell button, knows exactly how much money they are willing to risk on that single trade. They decide this before entering the market, when they are calm, rational, and analytical. They might say, on this trade, I am willing to risk no more than 1% of my account. Let's put this into practice. Imagine you have a $5,000 trading account. You've decided you will risk 1% on your next trade. 1% of $5,000 is $50. That $50 is your line in the sand. It is the absolute maximum you will allow yourself to lose if this trade goes against you. Now, you've analyzed the euro to US dollar chart, and you've identified a great entry point. Based on your technical analysis, you determine that if the price drops 25 pips below your entry, your trade idea is proven wrong and you need to get out. That 25 pip distance is your stop loss. So you have two key pieces of information. You can risk a maximum of $50, and your stop loss needs to be 25 pips away. The question is no longer should I buy. The question is, how much should I buy? What lot size do I use to ensure that a 25 pip loss equals exactly my $50 risk limit? This is called position sizing, and it's the holy grail of capital preservation. Here's how you figure it out. We know that on euro to US dollar, a mini lot has a pip value of $1. If you traded one mini lot and the trade went against you by 25 pips, you would lose 25 times $1, which is $25. That's well within your $50 risk limit. In fact, you could trade two mini lots. With two mini lots, each pip is worth $2. A 25 pip loss would be 25 times $2, which equals $50. Bang! You've hit your risk limit perfectly. So for this specific trade, your correct position size is two mini lots. You see what just happened? We used the concept of the pip, its dollar value, and a predefined risk tolerance to calculate the exact professional position size. There's no guesswork, no emotion. It's pure, calculated risk management. You enter the trade knowing the absolute worst-case scenario. If you're stopped out, you lose $50, which is 1% of your account. You live to trade another day, completely unfazed. If the trade goes in your favor by 50 pips, you've made $100, a 2-to-1 reward-to-risk ratio. This is how a trading business is run. This is also where the concept of leverage fits in. Leverage is what allows a trader with a $5,000 account to control two mini lots, which is 20,000 euros, an amount far greater than their account balance. Brokers offer leverage as a tool to control larger positions, but it's a tool that must be respected. Leverage doesn't change the value of a pip. A pip on a mini lot is still worth $1. What leverage does is amplify the impact of that $1 per pip movement on your smaller account balance. It magnifies both your potential gains and your potential losses. By using proper position sizing like we just discussed, you are effectively controlling the leverage you use on any given trade, ensuring that it works for you, not against you. By mastering the relationship between pips, lot sizes, and risk, you transform trading from a gamble into a series of calculated business decisions. You stop focusing on how much money can I make, and you start focusing on, how do I intelligently manage my risk on this trade? And that shift in perspective, that fundamental change in your approach, is what will ultimately determine your ability to remain in the market long enough to find success. You start focusing on, how do I intelligently manage my risk on this trade? And that shift in perspective, that fundamental change in your approach, is what will ultimately determine your ability to remain in the market long enough to find success. This entire crucial concept of risk management, the very bedrock of a sustainable trading career, all comes back to that one tiny unassuming thing we started with, the pip. It's almost poetic, isn't it? We dissect these grand strategies, we talk about global economic trends, we analyze complex chart patterns, but none of it matters, not a single bit, if you don't have an unshakable, intuitive grasp of the smallest unit of movement. Think about it. How can you define your risk in dollars if you don't know how to convert pips to dollars for your specific pair and position size? How can you set a logical stop loss if you don't understand that a 50 pip stop on euro to US dollar means something completely different from a 50 pip stop on pound sterling to Japanese yen? You can't. It would be like a construction engineer trying to build a skyscraper without understanding the inch or the centimeter. The entire structure would be built on guesswork, destined for collapse. The pip is your inch. It is your fundamental unit of measurement, and mastering it is non-negotiable. Let's take a moment and just zoom out to appreciate the journey we've just been on together. We started with a simple, almost intimidating question. What is a pip? It sounded like jargon, like a secret handshake for an exclusive club, but we broke it down. We revealed it for what it is, simply the fourth decimal place for most pairs, or the second for yen pairs. The percentage and point. No magic, just math. Then we met its little cousin, the pipette, that fifth decimal place, and we understood that it's just for adding a bit more precision, like the milliseconds on a stopwatch. It's good to know, but the pip is the star of the show. But knowing what it is was just the first step. The real lightbulb moment for many traders, the point where the abstract theory crashes into concrete reality, is when we started talking about pip value. That was the bridge. That was the moment the pip stopped being a number on a screen and started representing actual money in your account. We walked through the formula, understanding how the quote currency, your account currency, and the current exchange rate all dance together to give that pip a specific dollar value. And once we understood that a single pip could be worth 10 cents, or a dollar, or $10, the next logical question was, well, who decides? And the answer was, you do. You decide through your position size. We dismantled the concepts of standard lots, mini lots, and micro lots. We saw how a trader with a smaller account could use micro lots to make a pips movement represent a manageable amount of risk, while an institutional trader might use standard lots where that same single pip movement represents a much larger sum. This is your throttle. This is how you control the speed and power of your trading vehicle. Finally, we brought it all together in the most important concept of all, practical application through risk management. We saw how this knowledge isn't just academic. It is the toolkit you use every single time you even think about placing a trade. You use your understanding of pips to define your exit points before you ever enter. You say, I am willing to risk 20 pips on this idea. And because you know how to calculate pip value and select your lot size, you can translate 20 pips into a precise dollar amount that fits your personal risk tolerance. My 20 pip stop loss with this mini lot equals a potential loss of $20. That is clarity. That is control. That is trading like a business owner, not a gambler. The pip is the universal language of the foreign exchange market. A trader in a New York skyscraper, a trader in a London office, and a trader in a Tokyo apartment might all have their accounts in different currencies, but they can all communicate in the language of pips. If one says, I made 100 pips on the cable today, every other trader in the world knows exactly what that means in terms of market movement. It's the great equalizer. It standardizes the measurement of profit and loss across the entire globe. So now that you have this foundational knowledge, what's next? Because understanding the pip, as critical as it is like learning the alphabet. It's the essential first step, but it doesn't make you a novelist. Now, you can begin to learn the words, the sentences, the grammar of the market. Concepts like leverage and margin will start to make more sense, because you'll understand that leverage magnifies the value of each pips movement, for better or for worse. Technical analysis, the study of chart patterns, becomes far more practical. When you identify a potential support level, you can now think, okay, I'll place my stop loss 15 pips below that level, and you'll know exactly how to implement that and what it means for your account. Your next step is to build a trading plan, a real one, a written document that outlines your strategy, your risk management rules, and your goals. And every single rule in that plan will, in some way, be based on pips. I will not risk more than 30 pips on any single trade. My minimum profit target will be a 2-to-1 reward to risk ratio, meaning if I risk 30 pips, I'm aiming for at least 60 pips. These are the kinds of concrete, non-emotional rules that can be built once you have this fundamental understanding. Think of yourself as a master craftsman, a skilled carpenter. A beginner just grabs a hammer and starts swinging, hoping to build something that stands. But a master, a true professional, respects their tools and their materials. Before they ever make a cut, they measure. They measure with precision. They understand their unit of measurement down to the smallest fraction. They measure twice and they cut once. For you, as a developing trader, the pip is your ruler. It is your measuring tape. Every trade you take, every stop loss you set, every profit target you aim for is a measurement. And your ability to measure accurately, to understand what that measurement truly represents in terms of monetary risk and reward, is what separates professional level thinking from amateur guesswork. Don't just learn what a pip is. Internalize it. Make it second nature. When you look at a chart, you shouldn't just see prices going up and down. You should see the ebb and flow of pips, the constant battle for every single point. We've covered a tremendous amount of ground, and we've transformed a piece of complex jargon into a practical tool you can use for the rest of your trading journey. This isn't the end of your education. It's the official beginning. It's the solid foundation upon which all future knowledge can be built. Without it, everything else is unstable. With it, you have a fighting chance. So, my question for you is this, and I really want you to think about it and leave a comment below. What was the single biggest aha moment for you in this explanation? Was it finally understanding the fourth decimal place? Was it the concept of pip value connecting it to real money? Or was it seeing how it all ties together with lot sizes and risk management? Sharing that moment helps not only you solidify the knowledge, but it helps others in the community pinpoint what's most important. If this complete breakdown has finally demystified one of the most essential but confusing topics in Forex for you, and you feel more confident than you did when you started this video, do me one small favor and hit that subscribe button and be sure to turn on notifications. We're just laying the groundwork. In our next video, we're going to build on this foundation and tackle the powerful and often misunderstood topic of leverage, and how traders have historically used it to their advantage without blowing up their accounts. You have the foundation now. Let's build the skyscraper. I'll see you in the next one.